Hi, everybody. Thanks for tuning in to the Coaching Call podcast. On this podcast, we'll cover various types of coaching by trainers in sports, martial arts, fitness, and business. We'll discuss each coach's methods to getting the most out of their respective athletes or clients and how they attempt to change the platform in which they coach. Join us on a fun adventure as we discuss unique coaching styles. Coaching is a universal part of how we get others to get something done. Join your host, Raphael, and his guests on this unique journey in coaching.
Hi, I'm Sifu Raphael, and this is the Coaching Call podcast. If you enjoy this episode, please subscribe and leave a review. This episode was made possible by listeners like you. Steve, wow, I'm super excited to have you. Welcome to the Coaching Call. How are you this morning?
Well, I'm great, thank you. It's a pleasure to be with you. I've heard a lot about your podcast by just looking at it, and I'm excited to be here.
Awesome. So one of the things that I normally in the past I used to read people's bio, but I don't think I did enough. Je ne sais quoi, right? So tell us, before we even get started, tell us a little bit about what makes you you today.
I guess I'm the result of 45 years or so of being in the stock market and the bond market, and working with people to help them achieve their financial goals. I've been a private portfolio manager since 1979. So I've been working with people through the three major meltdowns of that era: the 87 crash, the dot-com bubble, the Great Recession, and sort of mini crash from the COVID thing in 2020. So most of the people I worked with were still with me for years and years. I mean, the two guys that started with me in 1979 are still clients of my firm that I sold a year ago, May. So I'm the net result of that. I'm happy in what I do. I coach people on how to make more money with their investments. It's kind of easy for me to look inside what they've got and show them how they can produce more income safely. Mainly because I've been doing it so long, and it's satisfying when they tell me they don't need me anymore to coach them. I'm really pleased. I mean, in fact, in many occasions, I tell them, no need to set up another appointment. I think you've got this. If you've got a little problem, just send me an email. It's stuff like that. That's a good thing. I've worked with since I published my book in October. I've worked with over 70 people. And over 70 people is about half of what my total business was after managing money for people for all those years. I had, about 145 people that I was managing money for this. So I think it's a pretty good accomplishment. I'm getting the word out, and I'm helping people, and I'm having a good time, and I'm making a little bit of money. So
there you go.
What could be worse?
But when you say a little bit of money, we're going to get into that because a lot of people don't understand that a little bit of money goes a long way, right?
Well, actually, you have to have a lot of money to go a long way. But
you need to be frugal to make a little bit of money go a long way.
Well, you can if you're already generating a lot of money from your investment assets, like I am, then the fact that I'm making just a little bit of money now on this is my side gig. Let's say this is my retirement gig. Every little bit is satisfying, So it's okay. It doesn't have to be a big number.
Yeah, exactly. So let's get into who you are, because this is why I love the show. You're definitely the financial guy. You know money. You know how to help people, or even better yet, keep what they make. Let's talk about you when you were a child. Where did you grow up? Who influenced you before the age of 10?
Okay, well, I I moved out of the Bronx, New York, to a place
Is that
called
where
Lake.
you grew up? Is
That
that where you were
no,
born?
I was born in Manhattan. I lived the first 5 years of my life, which I don't remember at all, in in the Bronx, and then we moved to Lake Apacon, New Jersey, which is a 8 mile long, multi coved, and it's got 40 miles of shoreline for an 8 mile long lake. So it's one of those up in the mountains in North Jersey, which most people don't know even exist. And at that time, it was a very private community. It wasn't a resort. My father had a friend had purchased a large parcel of land, and they started the development there. So before 10, I was really a witness to a major business entrepreneurial undertaking where this person was taking vacant mountainous land and transforming it into a development, a community with everything, even a basketball court, football and baseball stuff, and a beach, a nice beach. So, and he still worked in New York, and he didn't get home till 7, so we ate late, even as kids. And he talked about what he did, and he talked about it a lot. And you kind of got a sense of how many different things he was doing while running this business, and encouraging us to find things to do with our spare time. I mean, I had a lawn mowing business when I was 12. And I not that's not pre-10, but it's close. You So, but the idea of entrepreneurship, even though we didn't even know the word, was ingrained in us from the start, my brother and I, to have something to do, education was important, you
Mhm.
know, to us, reading, all that kind of stuff. I mean, I guess we had the right atmosphere for eventual success and the support to, to do what we had to do to get there. So
So
that was the beginning phases. Yeah.
you would say that your dad was a big influence on you?
In the sense of his ability to make money, and I didn't know it at the time because it hadn't been labeled yet. But when I got to college and I started into economics and business, I realized that what he had going was what they call a vertically integrated business, where he owned the land, he sold the properties. Some of them he rented, so he had rental income coming in. He he took the mortgages back from people who bought homes, so he had that stream of income.
Mm.
So there was a lot going on, and so I understood then. Yeah, it sort of kicked me in the butt and said, now I see what he's been doing all these days. But it never gave me the incentive to go into that business because I didn't want to work 8 days a week like he did.
I love the fact that you said 8 days.
So as you probably know, when you're managing 110 million for 140 families across the country, pretty much an 8 day a week job too, isn't it? So I didn't really get my wish. I wound up working 8 days a week.
Yeah. I tell everybody that I'm really good at putting 36 hours into a 24-hour day.
Yeah, there you go.
So, considering you made me think, and I don't know why this popped into my head when you were talking about dad and his entrepreneurial ventures. You made me think of Robert Kiyosaki in the book that he wrote, Rich Dad Poor Dad, and how one of his dads just said, "School, you got to stay in school," and the other one was like, "You have to do different things. You have to think of business."
Yeah.
Did you ever have a conversation with your dad about doing, or was it just that you saw what he was doing?
I when I Later on, much later on, when I first started my business. When after I had developed my approach to investing, I started investing when I was about 25, and I learned an awful lot about the markets and things like that, and investments. At my job, I worked in a pension investment department of a large life insurance company in New York. And I was fortunate enough to have the opportunity to travel with some of the account managers of the big. Uh, it's a defined it's a defined contribution plan we had when there were no 401ks yet. There were no IRAs for that matter. There were no money market funds when I got started, but there were profit sharing plans and defined contribution plans. And our plan was all individual stocks or bond type investments. You didn't have any direct purchase rights. You could say, I want to be this much in the stock market and this much in the income market. That was the only choice you could make. Um, so I would travel with these guys to these other um, companies. I mean, companies like Boeing and
Mm.
Coors and big time name companies who they manage the investment programs for in these defined contribution plans, to introduce them to a new way we were going to start doing it. But
Mm.
I was able to have conversations with the investment managers, the professionals, the
Mhm.
guys that are making the day-to-day decisions, not just buying 100 shares of this stock or that, they're buying thousands or 10,000 shares and having positions in their portfolios of millions of dollars in a position in a a 6 or 7, maybe even $1 billion overall portfolio. So it was pretty. And when I looked at it and I saw it, and I saw companies I recognized the names of. I didn't see new issues. I didn't see companies that weren't paying dividends.
Right.
I saw good, high quality, everyday, safe, seemingly safe under most circumstances. So that seemed to be a good, and I used that to develop my own portfolio.
Mm.
But I did one thing that they didn't do.
Right.
I took profits.
Mm.
I traded. That's what I got from my dad. That was the part. You don't just buy these houses to see their market value go up. You buy these houses to sell them, so you can build more properties and so on.
To
So
continue to build a Lego concept, right?
yeah, yeah, or a monopoly board. There's a lots of parallels. But that's what I did. I started to develop a second stream of income in my portfolios, and it got to the point where I was making more in profits in a year than the companies were paying in dividends in that year. And then I carried that forward to my process today. But by the time I was 20, by the time I was,
You're jumping the gun. You're going ahead too
I
soon.
know, but
We were at 12 before.
but that's but so I started investing at 25,
But
and
before, let me ask you this question, right? You saw what your dad is doing. He really didn't show you the ropes the way that I was thinking, but he kind of helped you understand by you seeing that yes, to keep the profits coming, you have to sell so that you can make. At what point did you, was it at 15, 16, 18, 20, that you realized that investing would be something that you grow a passion
I went. You might say I went bad for a while. I became somewhat of a rogue, um, and really didn't pursue anything like that.
for?
I had the jobs,
Right.
but with the rest of my life, I wasn't thinking of much else. I was into sports. I was playing ball. You wouldn't believe it today, but I was big for my age. My brother was 6'4". When I was 12, I was already almost 5'7".
Mhm.
But unfortunately, it stopped. So the sports careers were out of the picture, and I was a little frustrated about that. And I really didn't do much with myself at all in that
Yes.
full. I was out to have fun. I was partying, I was going water skiing, I was doing stuff like that and working. But whatever money I made, I spent. And you know, uh, so I was not certainly not the man I am today. And I don't think I got there until I was beyond college. I was not really. I was, it wasn't a problem for me to get decent grades, even though I didn't go to classes all the time. I was not your good student. I was not anything like that.
Well, you were partying and
I was a fraternity guy. I wasn't a crazy drunk fraternity person,
gotcha.
but I was, I was, yeah, I was, and did get an education, but I really didn't get an education until I was employed and I got my master's, and that's when that's when it really took hold, and then I had a wife that just took me by the back of the neck and got me focused, and that's.
So let me ask you, at what point, because you said you had jobs, you were doing all these different things, and you just you by the back of the neck. Like many wives, guys by the back of the neck, right? And they say, get your act together, we need to make some money, we need to either buy a house or and so on. But when did you realize that investing was going to be your forte?
When I was on my 25th birthday, it was burst upon me. When I was working odd jobs and when I was working in my dad's lumber yard and things like that throughout the years, and I didn't have any other expenses, he took a percentage of what I made and he invested it for me. And this was, he told me that that's what he was doing with the money, but I didn't keep track of it. So when I was 25, my 25th birthday, he big old manila envelope was dumped on my desk or on the table in front of me, and I opened it up. 50 or 60. Have you ever seen a stock certificate? 50 or 60 stock certificates came out on my desk, and they were all those big name companies, like I mentioned earlier, the same type of company. So I had a portfolio of securities. They were all mine. And I was told that it was now my responsibility to take care of them. So that's when, with the broker I had and the coaching I was getting from these people at my employment in the pension investment department about why they had a gazillion dollars worth of Boeing stock, why didn't they take their profits and move on? And I found out about the politics of the investment community, where they literally told me, because Boeing is a big insurance customer of ours, they want us to own a lot of their stock. So the light bulb went off, and I said, "Whoa, whoa, whoa!" So theoretically, if there are 100 insurance companies and they all have the same type of thing with their clients, a lot of the price movement is based on their relationships, not necessarily on the economics of the situation. So that's when my selling, the selling became so important to me as soon as I learned that, even more so than it had earlier when I was taking profits. But now I put definite targets on my profits. So for the stock market, I had 10% profit. And if it got there, I didn't care what the stories were, what the rumors were, what the deals were going on. I took the profit and I moved on to something else. By the time I was 31 in or less, I don't know. It was 1979. I was 34. I was making 5 times my salary in the stock market. I had made so much in the stock market that I even had a portfolio of municipal bonds developing. Yeah. So taking profits, only buying things that pay dividends, only buying high quality stocks, keeping 30% of the portfolio in these municipals and other types of debt securities. Those are the basics that I developed and learned about, and just put into what I could put into a business plan, so that when I talk to a couple friends about doing this professionally and tell them this is what I did, these are my buying guidelines, these are my selling disciplines, this is my asset allocation plan, and so on and so on. They were impressed enough to say, yeah, as soon as you get a license, we'll So before I even had left my employer, I had already started taking my exams and getting registered, and started a corporation. My corporation was established in May of '79. I think I got my, it wasn't a Series 7 exam, that's a broker, but I forget what the number is, but it was some type of thing you had to do to get, be an investment advisor, and I did that. And within a couple of years, I had a business going.
Nice. Look back, right? So, current stocks, how they're moving. What are some of the ones that, I mean, for example, Google, we know some of the big names that are out there, Apple, so
Yeah.
forth. Why should we invest or not invest in those type of companies?
Well, that's a good question, because it points out a transition that I made around. I made a transition out of the general market for fixed income securities around around the time of the dot-com bubble, about the turn of the century, where I moved from in bond unit trusts and Ginnie Mae's, individual municipal bonds and things like that, to closed-end funds, because they trade like stocks. They had exactly the same securities inside, and they paid twice the income. But I hadn't switched out of stocks until after, not to any great extent, until after the financial crisis, and that was because they stopped going down. They had gone down. I had bought them, because that's what I did. I bought them when they went lower. But once the financial crisis was over, I was taking my profits, but I couldn't find anything to buy, because I only would buy things that were down 20%, from their highs, and all the good companies were up and stayed up. So I had to go, and I developed and I learned more about closed-end funds, and I moved from individual stocks to the closed-end fund equity side, where all those names you mentioned, I mean, I can buy almost any equity closed-end fund and own every one of them. I don't have to worry about them. I've got a professional manager on my payroll now, and he's taking care of that part of the process. I'm just clipping the coupons, so to speak. I'm just collecting the money. The equity closed-end funds that I invest in today generate an average of over 9% income. On average, some of them more, some of them less. None of them as low as 5%. None of them. I mean, even they all do. You can get anything you want, any sector. You can get AI, you can get healthcare, you can get energy, whatever you want. You can find a closed-end fund that specializes in that sector. So I've taken my whole concept of doing that with the individual stocks in all these different sectors. Now I have diversified portfolio of diversified portfolios, and they're all generating around 9%. They become products on the shelves of my department store. My portfolio is a Walmart, and somebody comes in and they want to give me my 5% profit. Take it, man, it's yours. I put something else on my shelf, wait for the next guy to come in. And that's what I do all day. I don't do it all day. I do it an hour in the morning, an hour in the evening. That's about it. But still, the idea is that when you ask me about NVIDIA or Microsoft or even Exxon and Exxon Mobil,
Right.
or any of those, any companies, I own them, yeah, but I don't worry about them. I don't have them as a large percentage of any of those portfolios, and I don't have any closed-end fund as a large percentage of my portfolio. So I diversify, total diversification,
Mm.
3 times over. You know, so the whole concept of investing in the stock market has changed for me since what it was in 1979 when I got started investing money for other people, to what it was in May of 2023 when I
Mhm.
sold my business. There were no individual stocks in my client portfolios, none. There were.
Why did you decide to sell your business? What was the
Why?
catalyst for that?
You've heard the expression, "They made me an offer I couldn't refuse."
I have heard that expression.
Yeah. Well, I was 77. Yeah, I was 77 years old. They were offering me the equivalent of 6 years of the income I was making
Mm,
by managing the portfolio. 6 years.
mm.
I said that was a pretty good incentive,
Yeah, that is.
because and I didn't really know at that time. I knew I was being pushed to write another book. I knew that there were people saying I should write a book and tell the people about all what I'm doing, and I was almost convinced to do that, but I hadn't quite been there yet. But I had no idea I was going to start a coaching business until just a little bit after, when we really started, when the deal was pretty much in place. And when we were about to get the first check, some people asked me about it, and I said, "Yeah, I think I can do that." So I started working with that. Um, so now that's in pretty good shape. Like I said, I think I've already worked with more than 70 different people, coaching them on
Mhm.
how to turn their portfolios into a more income focused money machine than it used to be. So still having fun.
I hope so. Let me ask you, Ed, I want to take you back to that day, that specific day. It's your birthday. It's your 25th birthday. Your dad comes with this money, probably wondering, what is in this money? By the way, I want to say, Jones, who was watching, gave a thumbs up. Thank you, Spencer. When we consider that day for you, you probably had no idea what your dad had. And that was a humongous gift. I mean, huge.
Oh, it was. Um,
But most people would say, "Whoa, this is incredible. I'm gonna go and turn it over and get the cash." That's what most people would do. Am I right or wrong?
well,
A lot
yeah, most people could think of doing that, but I guess I was in a pretty comfortable position at that stage of my life. I already owned a house.
Mm,
I had a mortgage, but it wasn't a big deal. I had a decent living with the pleasure of commuting to New York City from North Jersey, 45 minutes. That was just after Route 80 was built, and when they finally had a major highway. But I mean, the same commute would probably take 2 hours today.
crazy, isn't it?
But so I was pretty well fixed at that time. Remember, my dad was in real estate, and he had had the goods, so I had the benefit of that. Um, but uh, no, when I got that, my incentive was, this is a lot of money, and I am not going to lose a penny of it.
Mm,
So I didn't take it and buy a new car. I
mm,
didn't take it and throw it away. I recognized that it could be the thing, that could, that was so I no, so I addressed the issue. I didn't go out and sell any of it.
mm.
I studied all of those securities. I looked at the charts, and you would be surprised if you got a like, it's like the Dow 40 or whatever. if you were to look at all of the charts over the years for those things, you'd see the upward trend, but you'd see the volatility in each of them. You'd see that, and you'd say to yourself, if I took defined parameters and said, I'm going to buy them when they go down this much and sell them when they go up that much. And you look at those charts, you say, I could have done that 1,000 times. You know, I could have done it hundreds of times with any of these things. And I could own one, sell it, buy another one, have a diversified portfolio. I could find more with similar patterns out there that are paying dividends. And that's what I did. I got to the point where when we stopped, funny thing, the Standard & Poor's company used to have a stock guide, something you've probably not seen. They used to have a stock guide like this. And this is from June of 2018, which I think is the last one they ever published.
Wow.
But inside, it listed every stock on every exchange, and it gave it a rating from D to A plus, and B plus or better was what myself and my people I worked with would consider investment grade value stocks. B plus or better rated, traded on the New York Stock Exchange, and paid a dividend. Right. So B plus or better, you don't have any ones that don't pay dividends in that classification. You don't have any with these, the price earnings ratio of 35,000 to nothing, that type of thing. You have all the quality companies, and there are literally only about 225 of the equities that were at that time priced under $90 and above. I think my between 10 and 90 was the range I would accept, that made the thing called investment grade value stocks. That's what I called them. And those are the type of stocks we used and traded. So that was.
So let me ask you, back then, 25, the internet was not around.
Right, no internet.
So there was no YouTube, there was no Google research, all this stuff. Decide that you were actually, how were you pointed to the study guides that helped you understand what you about even today? Because now today's feature, but at that it might have been like, what is this? I need to get deeper into it. What was that like for you?
I don't know. The training and the education about the markets. I had a pretty, you might say, almost tunnel vision. You'd have companies coming out, IPOs and things like that. And there were the first tech stocks that came out. I was there. I didn't buy them. Because for every Google, there were another 100 that went to zero. You know what I mean? And you don't know until hindsight which ones are the good ones. Today, I don't worry about it so much because of the closed-end fund vehicles that I use. But I never was one for taking risk, and particularly once I started investing other people's money. I think that's probably the safety net that acted most for my portfolios as well. I used to tell people that I was working for that I would never, ever put them into any investment that I didn't own myself. That was a big selling point.
Oh, yeah.
Because they knew me, and they pretty much knew my family. And when I said that, they felt a lot safer. And that's to the end of the time, that's the way I did it. I never ever put anybody in something I didn't own. Okay. So that's the education is by doing. When you get to the point where you realize that if you vet the securities, just like you vet people,
Mhm.
if you can trust the quality, if the income it generates for you has become dependable over time, even growing over time, uh, if you have a diversified portfolio so that when Enron goes under, you don't get any phone calls
Mm.
because it was such a small blip
Right.
of their portfolio that nobody even noticed. But I must have owned that in 30 or 40 different portfolios.
Mhm.
So that's the type of safety net type investment program you can put together.
Mhm.
But as well as having enough of a position in each one so that when it went up 5, 10% when you were individual, 5% now, it was a significant number. And if you can do it often enough, this is where the trading comes in. If you
Right.
can trade stuff, just, you know, you look at every other business in our economy, they're not sitting there hoping that the value of their inventory goes up.
Right.
They don't get oh my God, we've got $3 billion of inventory. We are so rich.
No, no.
They say,
Have to
how
move
could
it.
right now they say we don't want to have inventory. It costs money to keep it.
Right.
We want to trade. We want to get that stuff into and out of those stores as quickly as we possibly can.
Yeah.
There's no reason not to manage an investment portfolio that way.
Mm. Movement is what causes, things to happen, right? So you need that movement.
Yeah,
You talked about, I think one of the most important aspects when you talked to the people and you told them, I'm only gonna help you invest in things I already invest in, the things I'm involved in. And that's huge on communication aspects because it builds that trust, right? They already know you, but it's not like you're saying, hey, I think this stock over there or this portfolio is going to do really well. You should go do it. Because
yeah.
you tell them to do it, but you're not in it.
Well,
That
that's
doesn't
you
build
know
trust, right?
right. When people go and they hire somebody, the guy calls them to
Yeah,
manage their money, or they pick somebody. I mean, the first thing that I would tell a person to do if you're going to do that,
show
take
me
a
the
look. Take a
portfolio.
look at the guy's portfolio. Does
Right.
he have a portfolio? If he doesn't have a portfolio, you're going to let him manage your money. You've got $2 million. You need somebody to help manage, and he doesn't even have a he doesn't have a portfolio. Give me a break. You're not going to hire that guy, are you?
Totally nuts. Totally
So
nuts.
yeah.
Let's take a look, a quick thing about communication. Take a look.
Welcome to Speaking Prowess, where we believe in the power of communication to transform lives. If you're ready to take your communication skills to the next level, we have a lineup of some of the most influential communication experts in the industry. These are the voices that will guide you on a journey to enhance your ability to connect, influence, and succeed. At Speaking Prowess, our mission is clear: to empower you through effective communication. We know that mastering the art of communication isn't just about what you say. It's about how you say it and the impact it has on every aspect of your life. So take action now and get ready to embark on a journey towards personal and professional growth.
Yeah. So when we're talking about that trust, right? We were both talking about, yeah, do you want to invest with somebody who doesn't have a portfolio, somebody who is not in the game, but they want you to play the game, right? That's a pretty risky thing that a lot of people have done because let's talk about all the embezzlement that has happened. My gosh, I'm thinking of the movie The Wolf of Wall Street, right?
Wolf of Wall Street or
Oh my God,
Bernie Madoff, things like that.
right?
Yeah.
I mean, it was such an entertaining movie, The Wolf of Wall Street, and chaotic, if you will, but it actually happened. And, they took advantage of a lot of people. And I think, as crazy as that is, people are still falling victim to things like that, right?
Absolutely. I mean, there are there are people out there that do take advantage of others, but I I'm struggling with how I'm going to say what I'm going to say right now. But think about the guys who advertise themselves as fiduciaries
Mm.
and fiduciary responsibility and what that is. I've looked at hundreds, literally hundreds of portfolios over the last year.
Mm.
And I've seen people with the strangest things that you can imagine in their portfolios. Some of them are their own fault. They admit to it.
Mm.
Some of them is because it was their dad's company and they need the stocks remind them of him. And you're not going to ever sell them. There are strange reasons why people hold on to certain investments. But there are also strange portfolios out there that people have because they have been encouraged to take on these models that supposedly are just for a person like you.
Mm.
Model portfolios. And when you see one of those, you can see them as soon as you open the account statement. You can tell he's got one share of Berkshire Hathaway, or maybe he's got 0.675 shares of Berkshire Hathaway, and he's got 67 pretty nice, great companies with fractional shares of all of them. This could be a child's portfolio.
Right.
His first $10,000 his grandfather invested for him. They throw it in a model like this. They tell the people, we're making these investment decisions for you. We didn't think and it's always we, it's not me, not I. I've never said a we. I don't care what anybody else thinks, frankly. But you see stuff like that. You see portfolios for retired people in their 70s, and you see their managed portfolios that are generating less than 2% income.
Oof.
Less than 2%. But they're huge portfolios. They could be $3, $4, $5 million. Instead of generating $500,000 in income, they're generating peanuts. And the guy's they're taking their 1.5% management fee. They're barely covering it with the dividends. And then when the guy says, hey, I need to take out $10,000 a month for expenses, where is it coming from? Because they automatically reinvest the little dividends that do come in. So to even pay their own fees, they got to sell something.
Right.
They never, ever take profits. The tagline is keep your winners sell your losers and let your profits run.
Yeah, they're running out the door.
Totally contrary to any understanding of the market cycle. The market is going to go down. It's going to go down periodically throughout your lifetime. And if it goes down, where's the money? Where's that 10 grand a month coming from? You got to sell something. They're only not taking they're afraid to take profits. Right. They'll sell losers, so your capital is being stolen from you, literally. It's just what I see makes the term fiduciary a joke. Who determines what fiduciary responsibility is? Now, if it's being determined by Wall Street, then they're doing their job. But it's not being determined by you and me, right, who are trusting them. In my case, I'm almost 80 years old. If I had a portfolio with you as my investment advisor and I know what I spend and I'm going to spend, $20,000 or $30,000 a month, okay, I don't want it coming from selling things at losses. I want it coming from income that you're making for me,
Right.
whether it's profits or dividends or interest or whatever.
Mhm.
So we don't have an environment right now where the fiduciary responsibility is being judged by the people for whom the portfolios are being managed. That's my opinion
Right.
on
And
that subject.
it's a very scary thought what you talked about. I mean, extremely scary, unless you have someone like you who can come in and look at your portfolio and say, wait a minute, what's going on here, right? So do you do almost if you take on a new client, do you want to look at their portfolio, see what's going on with it? Do you want to also um, maybe let them know that, hey, before I even look at your portfolio, I'm going to be super honest with you and let you know if this is actually working
Mm-hmm.
or it's not working and how we can fix it?
Yes. Yes, that's exactly what I do. It's I do a portfolio review with me contains four things. The first thing is what I call a QDI plus PT risk minimization review of your portfolios. That's a lot of words, but what I'm looking at, are they all high quality securities? Is your portfolio well diversified? Does your portfolio produce at least 4% in income? Because that's what your guy is telling you you need to take out in retirement. And the fifth thing is PT. Have you been taking your profits? And that's easy. You'll see the guy with the Microsoft that he's owned, probably bought it, maybe 3 or 4 years after it became a star, but still made a lot of money on it. But it's still, he's retired now. It's paying less than 1% income. Not something you should have there with 10% of your portfolio. You got to say, okay, I love you, but I'm selling you. You sell out of love, not hate. You want to be in a position to sell out of love, not hate. you know so so that's the first phase. The second phase is, since I assume they've all read my book, they is a Q&A session. Any questions they have about me, about the book, about portfolio management, about what's going on in the world economy, I don't care what it is, we took care of their questions. Okay. Then the third phase is that we develop a transition plan for taking their portfolio from where it is to making it an income focused, growing income portfolio. Income independence is where we want to get, and that's what we do. For that session and before that session, I give them the selection universes that I use for my own portfolios. So they'll have a list of 100 different equity closed-end funds that meet my requirements, more than 100 income closed-end funds, and 50 tax-free income closed-end funds for the big guys. And right now, those are yielding over 6% on average, tax-free, if you can imagine. And your broker will never tell you about it. And I'm not downing the brokerage community or the guys or the financial advisors. They get paid on the basis of amount under management, AUM, they call it, assets under management. That's how they get paid. That's how their bosses get paid. And their bosses do not encourage them to invest in things that do not grow in market value. Income securities, by their very nature, they're just not going to grow in market value that much. When interest rates go to zero, they may max out on their height, their level, but most often, they're boring as they can be. boring as they can be, but they produce income. And that's what people in my age group and young and much younger now, right? Um, should be are interested in. It's not that they should be, they are. Retired people want more money. They want to live their life, they want to travel, they want to see the world. They're not going to see the world on the investment portfolios that are put together by the community today.
Mm.
Okay.
That's huge. So when you consider, you talked about your book, and I know that you send it to me. I haven't received it yet, but I can't wait. And I know you're going to come on other shows, and we'll talk more about your book. When you consider everything that we've been talking about, and you've been giving great advice along the way, it's just your nature. But what made you write that book? What was the point where you said, I need to let people know
I
what I
I,
know?
I meant I sort of alluded to it earlier that I was kind of forced into writing the book. I have this Facebook group. It's called Closed End Funds for Retirement Income and Equity Trading, and it's got almost 2,500 members in it, and it's a pretty good active discussion community. And we were all they had all known about my previous book, which was written for this basically for stock market investing, but they wanted me to write another. So I told one guy, I said, you go ahead and write it, and I'll edit it. So we did that, and he tried, but I said, okay, I'm going to do it, but I'm not going to write it myself. I'm going to have a ghostwriter do it, and the ghostwriter is going to be expensive. And if you guys really want this to happen, we're going to have we're going to form a partnership between you who want me to write the book and me. And I'm going to tell you how much the ghostwriter and the overall expenses of publishing is going to be. And we're going to raise that amount of money to develop this book together. And we did it together. We did an outline together of what should be in the book and what sequence it should go in. We did Q&As with the members of this Facebook group and the other Facebook group that I have, and tried to answer everybody's questions. We even have a whole chapter in the book which is a Q&A. An actual Q&A, and the people who are raising the questions, I think we mentioned their names and everything, so it's a really good show. And that's where the book came from. Literally, I had a half a dozen people who I sent manuscripts to get comments, and got them back, and we all did that. We talked about it a lot, and finally I turned it over to the ghostwriter, and then she and I did the rest of it.
Very cool. Very cool.
It was
I
quite.
can't wait to read it. I'm excited about it.
But what it does: quality, diversification, income, profit taking, the market cycle, recognizing the market cycle and how you can take advantage of it by having disciplined buying and selling rules. The focus, changing your mindset from focusing on that bottom line of the market value to the bottom line that says, this is my income this month and this year. And that number is the number you want to grow. So that type of stuff is in the book. And then there's charts that shows how, and what happens with the 4% rule if you're only making 2% income, that type of thing. So there's charts and things, and a glossary of terms even. So it's not quite as textbookish as the last book was. It's more fun, I think, than the other one was. And it sold a whole lot more copies too.
Nice. It's always helpful. Steve, my final question is, what do you think of, I don't want to have your take away from what you're doing, but I've had a lot of conversation with people, and what are your thoughts on Ray Dalio? As far as, you know who he is, right?
I recognize the name, but I couldn't tell you what he does or anything. Sorry.
Then let's forget that. So,
well, good.
So let's talk more about you. You're about to be 80, but you're having a blast. Is that why you haven't fully retired? You're still doing these things. You're still helping.
I, you only can play golf so many times. After a while, and after a while, particularly if you like to walk the course,
Mm,
it's really hard to do it that many times. So no, I thoroughly enjoy this kind of stuff, and I'm not the type of person that can not be busy. I don't.
mm,
I can sit around and do word puzzles and crossword puzzles only for so many times before I fall asleep.
mm,
And we don't really, my wife and I, we don't spend a lot of time in front of the TV. We do stuff. We want to do things, and we travel. You know, so I keep busy all the time. And the only time I really read, and I read fiction, and mostly stuff like oh, what's his name? I don't know. Like Jack Reacher. Do you know Jack Reacher?
oh
Are
yeah.
you a friend of Jack Reacher's? I am.
Oh yeah.
I've read every one, and I just can't. I know there's a new one out now, and I can't wait. I'm going on vacation next month, and I'll make sure I have it with me. But that's only the kind of reading I do. I don't like to read other people's investment books
Mhm,
because I think I've got a methodology that's been working just fine for all these years, and I don't want to mess with it. I'm sure there are other fine, wonderful ways of doing this.
mm,
I haven't seen any that are as income focused as mine is, but I'm sure there's some out there. I
absolutely.
don't know. I hope there are some out there. I hope I'm not the only one. But
Well, guess what? Hopefully, everybody who listened to the show today will go, wow, great information. Steve is a great guy. I think I should need to reach out to Steve. So we have your website coming across here, right? The incomecoach.net. And I suggest everybody go check him out. He's also got links to his book, and it's going to be a great conversation that we're going to continue having, you and I, and you're going to come on my other shows. I'm super excited for that. Um, what would you say, in parting, what would you say is a quick 30-second advice you can give someone besides read your book?
well, no, even before you read the book, this will make you want to
Mm,
just go to your latest account statement and determine how much income you are making
mm,
each month, each year, and compare that to if you happen to be in a managed program, determine how much in fees you are paying for the year and determine what your net income is. And then think about having between 7 and 10% net income a year in as safe as just as safely. Just think about that difference and what it would mean to your life.
mm. Beautiful, beautiful. For me, I look at my statements daily so that I know exactly what's going on. Um, and, and, and even sometimes even my credit card statements, like, why am I being charged for this? What's going on? And I'll call people up. I'm like, hey, did you double charge me? So I think that's important to keep an eye on that bottom line, right?
Yeah, the income bottom line instead of the market value bottom line, because that's going to change every day.
Oh, yeah, absolutely. My friend, thank you so much. I look forward to your connection. Amazing rest of your day.
Okay, thank you. Good talking to you.